350 stores just vanished from the US retail map, not in some obscure sector. This is a major discount retail chain, and what they just announced should terrify anyone still betting on traditional brick and mortar. Welcome back to TechMeHome, MarketPhase Daily News. I'm your host, and today we're breaking down a market that's sending wildly different signals, and why that matters to your portfolio. Let's start with the elephant in the room. Retail is contracting. The company shuttering 350 locations is essentially surrendering an entire business model. But here's what makes this worse. They're not disappearing everywhere. They're surviving in 6 states. 6. That tells you everything you need to know about consumer geography in 2026. High-income regions? Fine. Middle America? Obliterated. It's a 2-tier economy playing out in real time, and the stock market is pretending not to notice. This is what structural decline looks like. It's not a recession. It's not temporary. It's permanent. E-commerce won. Concentrated wealth won. And traditional discount retail, it lost. The company's survival in those 6 states suggests there's still cash flow in affluent metros. But losing 350 locations means they couldn't make the math work anywhere else. That's not a pivot, that's a retreat. Now here's where it gets interesting. While retail is imploding, the stock market had a fantastic Friday. The S&P rallied on oil stabilization and a massive tech surge. Semiconductors, quantum computing, energy transition plays, all hitting records. This is institutional money running toward AI infrastructure and advanced chips. ARM Holdings, Astera Labs, Navitas, Xanadu Quantum, all crushing it. And you need to understand why. The reason is simple. These companies are seen as de-risked. Analysts upgraded them on conviction. People believe in the fundamentals, they believe in the earnings. That's the opposite of retail, where the fundamentals are collapsing and there's nowhere to hide. But here's where we need to talk about what's actually happening under the surface. The Fed kept rates steady, inflation is supposedly under control, yet we're seeing divergent economic signals that don't make sense together. Retail's contracting, consumer spending strong, tech's booming, Main Street's dying. This isn't a healthy market, this is a bifurcated one, and bifurcated markets eventually break. Look, I get it. The market's confusing right now. You're trying to protect your nest egg, but you don't know who to trust. That's exactly why you need to understand where your money actually is. Consider setting up a diversified watch list that tracks both the winners and the warning signs. Apps like MarketPhase help you do exactly that. Real data, no hype. Stay informed, stay protected. Now let's talk about something that should concern every IPO investor out there. SpaceX just filed for public markets, and Elon Musk's House of Mirrors just got a lot more transparent. The filing reveals interconnected relationships with Tesla, the Boring Company, and Neuralink. In plain English, capital allocation across Musk companies raises red flags about conflicts of interest. If you're buying SpaceX shares, are you really investing in aerospace, or are you investing in Elon's personal empire where money flows in mysterious directions? Think of it like this. Imagine you own a restaurant, but the owner also owns a food supplier, a delivery company, and a real estate company. Every dollar spent could be feeding his other businesses instead of growing the core company. That's the concern here. It adds transparency, sure, but it complicates valuation in a competitive market where margins matter. On the biotech side, something actually good happened today. Immunovant hit a 5-year high on Sterling arthritis trial results. This is what de-risked pharma looks like. Real clinical success validating a treatment approach. If this works in arthritis, the pipeline opens up for broader autoimmune markets. That's genuine catalyst-driven upside. But here's the warning nobody's talking about yet. Australia's financial regulator just flagged rising private credit risks. Non-bank lending is opaque, leverage is elevated, rates are still high, and regulators globally are waking up to a problem. Private credit has exploded while nobody was watching. That's the next shoe to drop. When rates were falling, private credit was a gold rush. Now that rates are sticky, that leverage becomes a noose. So here's what Friday's market really told us. Growth assets are winning, semiconductors are winning, AI infrastructure is winning, but retail's dying, Middle America's struggling, and shadow banking is getting riskier. That's not a market signal. That's a warning signal. You've got institutional money piling into Biotech, which feels bullish. But underneath, the foundations are uneven. Retail contraction plus private credit risk plus bifurcated consumer spending equals a market that's vulnerable to shocks. The question you need to ask yourself is simple. Am I positioned for the winners, or am I holding on to the losers? Because 2026 is turning into a year where that distinction matters more than ever. None of this is financial advice, purely for entertainment. Always do your own research before making any investment decisions. Thanks for watching TechMeHome, MarketPhase Daily News. Subscribe, hit the bell, and we'll see you tomorrow.